This session is meant to address negotiating term sheets. I put a particular focus on entrepreneurs. As an entrepreneur, what you need to know and understand in order to be in a good position to negotiate your term sheet. So just so I get an idea, who here is a founder, entrepreneur, or works in a startup? Okay. And for the remaining, is anyone a lawyer or works in a VC fund? Nope. Okay, great. So this is meant to be interactive. It's a very broad and general presentation. If you want any more information on a specific point, please interrupt me. I'd be more than happy to answer any additional questions. So negotiating term sheets. A term sheet is kind of the initial 1 to 5 pager agreement an entrepreneur will sign with a venture capital fund when trying to get financing from them. It's one of the several steps in the process. In reality, term sheets is more, we could say, a kind of equilibrium between the valuation you get and what you're giving to the VC fund in exchange for that valuation as a means to protect themselves against potential downsides. So a quick rundown of what we're going to do today. If anyone wants to put more focus on anything, just let me know at any point. First, I'm going to give a quick introduction of venture capital. What's a venture capital fund? What's behind it? And why a venture capital fund will ask for what they ask in term sheets. Then economic terms in term sheets, governance rules, shareholding, how to control who's a shareholder in your company at any point in time, and exit, facilitating exits for investors and all shareholders. The money behind VCs. When an entrepreneur pitches to a venture capital fund, they're not actually talking to the fund. There's a layer that most people don't see, which is the money. The investors, who are also called LPs, invest in a company that enters into a management agreement with the fund manager. And the fund manager is the person, such as myself, who will be negotiating and dealing with the entrepreneur to make investment decisions on behalf of the fund. To give a bit of background about myself, my name's Audrey. I work at Leap Ventures here in Beirut. We're a growth stage fund focused on companies that already have a working product and would like to expand. We're there to provide, of course, financing, but also advice and help in scaling companies. I'm a lawyer by training, studied in France and the US before taking the bar exam, and then worked for private equity firms, so mostly finance, almost exclusively finance, actually. Just finance, and I moved back here about a year ago, and I'm now working in venture capital, which is very exciting, and participating in the creation of this ecosystem here is proven very interesting. So, I'm here. Banks give us money under 331 are here. And the companies that we invest in are here. This is a delegation that we're getting from this company. And so just as any business owner is accountable to their shareholders, we are accountable to our investors. The typical duration of a fund is 5 to 7 years. That's for all types of funds. And that actually determines a lot of what goes into term sheets and why it's there. The profile of a venture capital investment is high risk and high return. That's because the whole portfolio being high risk, if you invest in 10 companies, you expect that maybe 7 of them will fail or not do so good, but that the other 3 will do so well that it will more than make up for that. And you're looking for an average return across your portfolio that's satisfying to your investors so that they invest in your next fund, basically. So it's a reputational thing. The investment process in Lebanon takes 3 to 6 months. In the US, that's usually 2 to 4 weeks. The difference, there are many reasons. The ecosystem here is not always ready. People don't really know what to prepare when they go see a fund. And a lot of times we've had people knock on our door saying, hey, I've got an idea, without further information. So then that takes a lot of time to put that information together and try to extract from the business owner or the founder what their plan actually is. Another reason is that the quality and reliability of information in Lebanon is often not as good as in the US, and also that legal remedies, if anything goes wrong and you want to go to court, are much more difficult to achieve here. So the process is as follows. Start by sourcing the deal, going through an initial business screening. Is the business model okay? Do we think we can make money out of this? Do we like the entrepreneur? Do we trust them? Do we see a future in our collaboration together? Then we do an initial due diligence, which is a more focused business, still business-oriented exercise, after which we will issue an initial term sheet. That's the standard that each fund has. It's a basis for negotiations. What you should know as an entrepreneur is it's never this or nothing. This is a starting point. And you can negotiate it, of course. You can argue for or against a lot of things. After the initial term sheet is issued, we do a more in-depth, still business-oriented due diligence while negotiating the term sheet until we get to a final term sheet. And the signature of that final term sheet is a significant and very important point, because that's when you, as an entrepreneur, if you are an entrepreneur, or the entrepreneur generally, enters into a no-shop provision, whereby they stop talking to other funds. The reason behind that is that after the term sheet's signed, an in-depth due diligence takes place, where the fund will hire outside advisors, be it technical advisors, financial or legal advisors, to do an in-depth review of the company, its documents, its operations, and that's very costly. So a fund is saying, hey, I'm going to put in some money already before we even agree on anything final, so please, at least during that time, have the decency of not going to someone else while I'm doing the exercise for you. Once the final due diligence is done, that's when the final binding agreements are entered into. The term sheet is a roadmap. The better it is, the easier the process to reach the final agreements will be. So it is worth spending a lot of time at that initial stage. Term sheets usually are not. They will say that we're not binding, except usually for a couple of provisions. That would be confidentiality and no shop provision. Hello? Test, test. So, sorry, getting back to your question. No, term sheet is not binding unless it states that it's binding. And usually it will state that the no-shop provision and confidentiality are indeed binding. A couple of things you may want to think ahead before entering into a final term sheet. First one is choose your VC wisely. The terms are not everything. Of course, they're an important part for everyone, but they're not the only element. The experience of the venture capital fund that's coming in with you, the synergy you feel with them, the trust you have with them are very important elements to take into consideration. And who you sign with is more important than what you sign. Can anyone hear me like this, or is it too confused? Yeah? Okay, great. Another key element when negotiating, be aligned on the... It's a laser shipper. Yeah, I hope they had fun. Next key element. Okay. Be aligned on the vision with your venture capital fund. If you know what you want and you know that you want to reach it together, it will be a very happy 7 years. An ideal VC fund will want to be the person you go to if you're in trouble, not the person you hide from if anything goes wrong in your operations. And next, start the process early and make sure you have enough cash. Because during that time, you're running on your regular budget, which is probably, if you're an early stage VC, you're losing an early stage startup, you're losing a lot of money. So make sure you have enough cash to keep you sustained throughout the process and after the process, in case it doesn't result in a final investment. It's actually happened several times to us that founders come to us saying, I was in discussions with this guy, we've been talking for a year, now I'm dry and they're still holding on the money, I don't know what to do anymore. And we try to help any way we can, but the best way to avoid this is just make sure you have enough reserves and start really as early as you can. In the perfect world, the investor-entrepreneur relation is that. A relatively long marriage with no divorce possible. So make sure you trust each other. The first honeymoon period is, easy for everyone. Everybody's beautiful. We like each other. Yeah, you're going to give me money. You have experience. But then it can turn sour. So difficulties arise. And the best way to avoid a long-term dispute is to just think ahead and trust the person you're with. On economic deal terms, these are what founders pay the most attention to. So I'm going to try to go very quickly on these. I think they get a lot of attention as is, especially valuation. Valuation is important for everyone. You want to be the CEO of a multi-million-dollar company or tens of millions of company or a billion-dollar company, but it's not the most important element. It's one of the several elements, and the higher the valuation, the more you're going to have to pay for it in terms of what protection you give to your investors. The term sheet will also state the investment structure. Much better. Structure includes maybe an employee stock ownership plan, which allows you to keep your employees motivated by ownership in the company rather than salary, which also gives you the leeway to pay a bit less, reducing your running costs and how much your VC is bleeding money. Another structure consideration are 331 requirements. That's only in Lebanon. Circular 331 allows investors to invest 331 funds only in Lebanese companies. The criteria are not set in stone yet, and they're evolving, and nothing clear has been communicated to the public. But we're working with them and working with Banque du Liban. Every time a new case comes up, we try to determine what the best structure is that is both valid for BDL, legal for us, and allows us to do our job as funds, which is also add value to our investors. Another structure consideration is the type of shares that investors will get. These can be preferred shares or common shares. Preferred shares are usually what is standard. There are several ways to go, so don't be surprised if you see a preference shares in your term sheet. To be clear, that applies to equity investments. Sometimes you can have a term sheet for a convertible loan, and when you're signing a term sheet for a convertible loan, these questions don't come up yet. They'll come up at a later stage. So if you're agreeing to a preferred, you're trying to minimize participation and accruing dividends. Participation is of two types generally. It can be a non-participating preferred, also called a straight preferred, or a participating preferred, which basically means the difference is that in a non-participating preferred, the investor gets, in case of liquidation, a certain multiple of their initial investment, or their share of distributions in the company, whichever amount is higher. Whereas in the participating preferred, they get this multiple of their initial amount, of their initial investment, plus their pro rata share of distributions. Next up, dividends. Some term sheets and some preferred shares ask for fixed dividends. Usually it's not ideal if you're a startup because you need the cash. It's not a loan, it's not something you're taking to repay it. The investor is also taking a risk with you. So accruing dividends every year, especially if you need to pay them effectively every year, is not ideal. If you can pay them at a later date, then it's quite standard. It happens a lot. You can always try to negotiate that downwards, but sometimes it's not something that should prevent you from entering into anything. Next economic term is down round protection. That carries a strong link to valuation. The higher the valuation, the more down round protection the investor will want. To give a quick definition of what that is, it's basically a clause that says, I bought my shares for $10 a share. Someone comes in 6 months later and buys the same shares for $5 a share. I'm saying, hey, you oversold to me. I wanted to pay lower than that, but you told me your company was worth $10 per share. So a down round protection is me asking to enter at the same price that the second investor is coming in. There are two types of down round. Either full ratchet, which is me entering at $5 per share. You issue to me the same amount of shares that I would have received if I had initially paid $5 per share. So you're effectively giving me free shares 6 months after the investment. Or a weighted average, which tries to find a midway between what I paid, my $10 per share, and the $5 per share that the other investor paid. This is a fairly complex mathematical formula. We're not going to apply it here. And there's another course at 4:30, another workshop that focuses on down round protection that Rita is giving. Sorry? There's usually no limit. It's any point in time in the future. It happens, and it's happening a lot, especially right now in the US with companies that are taking on last rounds of private investments before going public, and they end up paying a lot of money after they go public because the IPO price is lower than what they paid. So a recommendation generally to entrepreneurs is try to go for the weighted average. This way you're sharing the risk. Full ratchet can be very, very painful. So can I give you an example of the wording of liquidation preferences in term sheets? I thought this would be useful for entrepreneurs to be able to identify both. A liquidation preference can apply in case of happy events or not so happy events. Happy events being a consolidation, merger, acquisition, so being bought out by a strategic investor, and a not so happy event being a liquidation, dissolution by court because your company is not going to work out. The wording you'll see for a non-participating preferred is pay specific attention to the higher of or. So it'll be the higher of 1.6 times my initial investment amount or my pro rata share in the distributions of the company. In the participating preferred, the language is a bit different. So you'll have, upon a liquidation, I get my 1.6 times investment amount. Thereafter, or after that, any additional pro rata distributions that I'm entitled to. If you want to model the liquidation preference financially, and it's a good idea to do this early on while you're negotiating your term sheet and before you're signing the final one, imagine a $5 million investment at a $20 million pre-money valuation. That means that post-investment, the investor will hold 20% of the company. Now imagine that the value of the company goes down and you end up with liquidating the company for a value of assets of $10 million. In such a case, the 1.6 time non-participating preferred is getting the higher of 1.6 time its investment, which is 8 million, or 20% of the liquidation amount, which is 2 million. Obviously, it's going to be 8 million because it's the higher of. That means that the holder of 20% of the shares is getting 80% of the distributions, whereas the remaining holders of 80% of the shares are getting only 20% of distribution. This will look and sound very unfair, but I would like everyone to consider it from a different point of view. At this point, when someone puts in $5 million in a company, no one else has put that much money or that much faith in this project yet. So this will be the single biggest investor, the person who is taking the most risk on this company, which is also why they want this protection. So that's one aspect. And another aspect is that if you were to split the $10 million evenly, then the founder and the early shareholders would be making a profit, while the last investor who put in $5 million would be losing money. So the idea is also to not give an incentive for people who are already gaining something to not want to grow the company further. In terms of in a situation where the same investor has a one-time participating preference, then they're getting their initial amount, which is 5 million, plus 20% of the rest. So as you can see, in this situation where the liquidation amount is lower than the initial valuation, having a participation with a lower multiple is actually more beneficial to the existing shareholders. But that's not the case if you have, for example, a liquidation amount of $50 million. In that situation, the investor's getting 10 million in a 1.6 time non-participating, which is their, if you want, fair share, because they're splitting equally with everyone else in that situation. But the one-time participating is getting more. So there's no clear answer to this question. Which one's better? It depends what you expect your company to do, how much you expect it to be worth, and what your objective is. Think incentives. The idea is always that a low liquidation should not be beneficial for you, and that's what the investor wants. But also study your scenarios ahead. If you have faith in your project, usually you can find a way to not have this stop completely your negotiations. So being done with economic terms, I now like to turn to governance a bit more. Governance is very important once the investors come in, of course, because it's your company, so you want to keep control of it on the one hand. On the other hand, the investor wants to protect themselves against any changes in your company that may make them lose value. These are the initial premises on which you're going to negotiate. How much do you want the investor to be involved, and how much does the investor want to be involved? What value can they bring to your company? These are very important questions to ask yourself early on as you're approaching the investor. Governance rights come in two groups. First one is composition of the board. The more of a stake the investor has, the more seats it will want on the board of directors. A nice rule of thumb usually is try not to give a majority or control of your company to an investor. It's your company, you want to run it, it's also your project, and if they're investing in you, then they should be trusting the entrepreneur to carry that project forward. Also consider getting an independent director in there. They will bring in a lot of additional expertise, and they're a third party that is usually neutral and will help you resolve any issues you might have. Another aspect in governance is reserved matters. There also, the idea is to strike a balance between investor protection and micromanagement of the company. For example, giving only one investor the right to veto any debt leans a bit towards micromanagement, whereas having a certain, let's say, giving them a veto power to take debt over a certain amount is fairer, because you can agree on this in advance and you won't have to go knock on their door every time you need approval for something. So governance is on a case-by-case basis. There's no clear rules for it. It will depend a lot on the trust you have in your investor and how much you want them to be in there with you. Another aspect to consider is transfer restrictions. These will help you control who's in your company at any point in time, but especially will help the investor control who is in the company at any point in time. There are two main reasons for that. The first one is that the VC fund is investing in the founders. They're the most important assets of that company. Another aspect is that by having a bad or someone who doesn't have the same vision coming in at a later stage can really negatively affect the company's operations. And if your first investor is concerned about the long-term well-being of your company and has the same objectives as you, they can be in a position to help you decide who your future partners are who can bring additional value for you. So they come in two types. First one is a lock-in of the founders. These are clauses that prevent a founder from selling shares for a certain period of time during the investment. It's usually around 4 or 5 years. And these are the 4 or 5 years during which the fund will be there with you. And if you're seeking venture capital funding, that means that also you intend to be there for the next 4 or 5 years. That's the kind of profile that venture capital firms tend to want to fund. So it shouldn't be an issue. If it is, then bring it up. If you have any specific concerns, usually investors will try to be understanding of what's happening and try to find a midway solution with you. Another transfer restriction is tag-along rights. These don't prevent a transfer, but they allow someone in the company to participate in any sale to someone. So if I'm an investor and someone in the company is selling 20% to an external third party, I'm thinking, oh yeah, I'd like to exit some of my shares as well. I'm going to put mine with you. These are also pretty standard in investments in general, not just venture capital, but also private equity. And they can be pro rata. So I can put in whatever percentage of shares you're selling, I can put in also that percentage, or they can be preferential, which means I'm putting in all my shares before anyone else is able to exit. Obviously, try to argue for pro rata whenever you can and it's acceptable. Usually, founders don't get a tag-along right because they're so important to the company that no investor wants them to exit. Next up, what I've called preemption rights. It's not the specific term to call these, but I thought it would be easier to help guide everyone. These can be the right of first refusal or the preferential right to subscribe. The right of first refusal is when you're trying to sell your shares to an external party, an existing shareholder who has a right of first refusal can choose to purchase those shares instead. So they don't prevent an existing shareholder of existing shares from exiting, but they allow the person who does not want another shareholder to come in to purchase their shares in lieu of the external party. So another objective can be to increase the investor's participation. If an investor believes in your company and they're willing to buy more shares, that's a good sign for you as an entrepreneur. A right of first refusal typically should be at the same price and same terms as the transfer that it relates to. So you don't want to give someone the power to prevent you from selling at $10 per share, but be able to buy them at $5. That will reduce your value. It's not what you're looking for. So things to consider when negotiating. Don't accept poison pills that will allow one single investor to determine who else can or cannot come in, or who will prevent you from raising money further down the line. This will affect your long-term growth. Also, again, choose your investor wisely. It's very important to be with someone with whom you feel a very strong connection. Final on the general agenda of list of items is facilitating investors' exit. So it can be either investors' exit or other shareholders' exit. The put option, don't throw tomatoes. A lot of people hate it, and a secret is, I personally don't like it either. We just haven't found a better way to achieve the goals that we try to achieve with it. So the goal is really a kind of guarantee on liquidity. The problem is that for many private companies and private investments, it's very hard to exit. And it's a problem that a lot of funds are having, is finding someone to sell to post-investment, even if the company is doing great. As I mentioned earlier in this presentation, after 7 years, the fund will be dissolved. And so we need to exit by year 7. Otherwise, it's a problem. These are the put option. I've heard arguments from lawyers that these don't exist in Silicon Valley. You don't get a put option. No, but you do get redemption rights, which are not available under Lebanese law, and that's why we have the put option in place. Yeah, as I said, it's really that liquidity risk that's a big problem, and we have not found a better way of dealing with it. If there's no IPO, then it's really hard to exit a company, especially in the Middle East and especially in Lebanon. The usual put option is around 2 times investment or specific discount on fair market value. Make sure it's stated in there. Lebanese law can limit their applicability. So for a lot of entrepreneurs who are worried about not having the cash to pay for these, usually you're protected under Lebanese law. A company can only purchase its own shares if it has enough reserves. So that's a kind of natural limit to how effective a put option is. Things to do, you can try to provide for delayed payment of the put option if you have certain cash needs or need to finance your working capital requirements. Your priority as a business manager is really to keep your company going. So it's good to be able to have this backdoor if you don't have enough cash to cover your needs, but at the same time you want to repay that put option and it's exercisable. It's something you can negotiate. A thing you shouldn't accept is a put option against the founders themselves. You as a founder don't really have the means, or are not really supposed to have the means to buy these shares back, and it's a big financial burden on you to try to, save up $2-3 million just to buy back an investor who wants to leave. And it also shouldn't be, the burden shouldn't be on you. Also, don't think that it's a guarantee on returns. A 2-time return on an investment for a venture capital fund is very, very low. We aim for over 10 times. But that's because the risk profile is so high that taking such a risk for 2 times return over 5 or 7 years is not worth it. It's just not worth it. So I've heard that argument a lot, that you guys want to cash out at my client's expense. No, it's not a cash out for us. It's really a minimum return guarantee. Finally, there are ways to facilitate everyone's exits, all shareholders. These are the drag along and registration rights. The drag along is a clause that allows a majority of shareholders to drag all the other shareholders into either a full exit or an almost full exit. It will basically allow an investor to gather around a majority of shareholders, and all these together would say, we're getting good value and we think this is a good exit. And we think you as the CEO have achieved whatever you could achieve as growth, so let's all exit, we're all making good money, it's fine for everyone. That's the case because selling a majority of a company or a full company brings you more value per share than selling the minority. Here also there are some things you can consider doing and some things maybe you shouldn't really consider. A drag along that's exercisable by a majority of shareholders, very standard. Drag along exercisable by just one minority investor, not standard. And you don't want to accept that because they have their specific interests and not everyone is aligned in that case. And as I said before, alignment is key for everyone. Another thing is that a drag along should apply to a large portion of equity. There's no general rule for this, but up to you to consider how much you're willing to give away. It shouldn't just drag along the founders. That doesn't make sense, and it will reduce value for everyone else remaining in the company. You can always request a floor price on the drag along, which means a certain value under which no one can be dragged, and that's sufficient and good protection for everyone. The ultimate goal for everyone investing in a startup, registration. If you do an IPO, that's how you achieve the most returns for any of your early investors. There have been recent fiascos, especially in the US, with people coming in very late at the last stage before doing an IPO and then realizing, oops, the company was overvalued and now I'm losing money. It happens a lot, but if you're an early investor, then an IPO is just absolutely ideal for you. Registration rights are twofold. First one is piggyback registration. That allows an investor, if you're filing a registration statement, to say, hey, I'm including my shares as well. It's not a problem. It's not an issue. It doesn't cost you anything. The only issue it can bring to your company is if the investment bank has told you that you should only sell a certain amount of shares, then whatever the investor adds to that will reduce the available pool for everyone else. It's the only drawback. Another type is demand registration. That's where the investor, who after an IPO still has some shares that are not listed, requests to list their shares on top of what's already been made. The problem with that is that registration is very costly. So you will end up paying for a new round of legal advisors, investment bankers to list those additional shares on the market. Demand registration is present in all the term sheets I've seen, and you probably are not going to do without it. What you can do, and ideas I've received from founders that were very interesting, is kind of set some conditions to that demand registration. For example, no registration has happened in the past 6 months, or there's X amount of shares being issued, so you're not making me register shares if they're worth less than $2 million. Otherwise, it's a waste of my time, my resources, and my company's efforts. A couple of final thoughts to guide the negotiation process for investors. First one, again and again, choose your investor wisely. The more you like them, the more they like you long term, the more aligned you are, the easier your relationship with them will be. The best terms come from competition. Until you sign that final term sheet, you are not bound by a no-shop clause. So go around, try to get the best terms you can, and the more term sheets you have, the better in a position you're in to negotiate really good terms for yourself. Choose your fights wisely. Some terms are worth fighting for, some items not so much. Some things will be a roadblock, whereas they don't really cost you much to give away, but are very important for the investor to know that they can trust you. And some of that is true the other way around. And for some things, you should really fight for your rights and maintain what you can. When you don't know what this is, don't be afraid to ask people for questions. The ecosystem is developing here, but there are a lot of resources. First of all, lawyers are becoming very competent, and also a lot of resources are available online if you'd rather do some pre-research before contacting an expert. That being said, when you do contact an expert, choose them wisely. We have had lawyers mess up deals, and we have had deals go down the drain because the lawyer didn't understand our needs as a fund, and we weren't able to reach an agreement with the entrepreneur. And by the way, the times that this has happened, the entrepreneur has usually come back 6 months to 1 year later saying, hey, sorry, I understand that I did wrong, and can we please start over? With that in mind, happy fundraising, everyone, for whoever's fundraising. Thank you. I'm happy to take your questions if anyone has anything they want to dive further into.
Hi, I'm Zena. I want to know regarding the exit strategies for entrepreneurs and for startups, what are the main challenges that a startup will face?
Do you mean challenges in terms of... Okay. So a big problem here in Lebanon specifically is trust at exit. So even when you do get a good investor on board, they will have trouble exiting after 5-6 years. And that's what dictates a lot of the protections we ask for. Because the market is so illiquid, and it's very hard to attract European and American investors to buy out companies in the Middle East. It becomes, I think that's the biggest risk that we face today here. Otherwise, the ecosystem generally is relatively good for startups. People are surprised often how good it is. You can find skill. It's hard to find, let's say, skill if you're not willing to give the right conditions. But when you are willing to involve someone actively in your company, and when you're willing to retain employees and give them equity in your company, you can attract some really good people.
I have a technical question regarding the equation that you just posted there on the slide. The P-money plus investment equal to post-money. There are two ways of looking at it. It's either you do the, and eventually this equation will help you basically determine the stake of the venture capitalist in the business. It's P-money as in you value the business P-money, and then you add to it the investment, and plus whatever added value is developed throughout this merger or marriage, and then it's equal to the post-money valuation. Or is the other way around, where you value the business post-money, and then you deduct the investment, and then you determine the P-money of the P-money valuation. So how do you determine the percentage?
Valuations are made pre-money. You look at the value of the company on the day right before you invest, and then you pay based on what percentage of this you're acquiring. You determine the price per share. So that's it. Any more?
I'm based in Paris, so how do I have to proceed if I'm interested in Leap Ventures?
We've been working with a company based in Paris, trying to see how we can get them to move some of their operations here. We're working on a structure right now. The first step, of course, is coming and speaking with us and our partners, trying to see if there's a fit more generally, and then relating to your business specifically, seeing how it can move, how it should be moved, or if it cannot, what the proper structure is for that. The difficulty arises when teams and assets are based outside, because one requirement under 331 is that most of the monies be spent in Lebanon. That makes sense if you have a team here, developers here. If you're able to hire good people in Lebanon, it makes absolute sense. If you're an internet company, it's relatively easy. If you have a lot of assets that need to stay in Europe, it's more difficult. Okay. Anyone else? No more questions? Grill me. Nope. Okay. Well, thank you very much, everyone.